Whether an investee is consolidated or whether some other form of accounting is applied has a material impact on the overall presentation of a reporting entity's financial statements. A reporting entity's investment in an investee may result in the reporting entity possessing some extent of influence over it. The level of influence that a reporting entity has over an investee can be broken down into the following categories: control, joint control, significant influence, or other. Control exists when the investor has power over the investee, has exposure to variability in returns from its involvement with the investee, and has the ability to use its power to affect its own returns from its involvement with the investee. Joint control results when there is a contractually agreed sharing of control of an arrangement and where decisions about the relevant activities are contractually required to be made jointly by two or more parties to the arrangement. Significant influence is the power to participate in the financial and operating policy decisions of the investee, but it is not control or joint control of those policies. Interest in an investee that does not result in control, joint control, or significant influence would fall into the category of other. When a reporting entity possesses control over its investee, it will generally consolidate the investee into its financial statements, and the relevant accounting guidance is covered under IFRS 10, Consolidated Financial Statements. When a reporting entity possesses joint control over its investee, the accounting basis and treatment will vary depending on whether the investee is a joint operation or joint venture. If the investee is a joint operation, the reporting entity will apply a line-by-line accounting approach within its financial statements to reflect the interest in the investee. This scenario is covered under IFRS 11, Joint Arrangements. If the investee is a joint venture, the reporting entity will generally apply the equity method of accounting for the investee in its financial statements, subject to certain scope exceptions. This scenario is prescribed in IFRS 11, but refers to the accounting model in IAS 28, Investments in Associates and Joint Ventures, for its measurement guidance. When a reporting entity possesses significant influence over its investee, it will generally apply to the equity method of accounting for the investment in its associate and its financial statements, subject to scope exceptions. This scenario is covered under IAS 28. For the other category, and assuming the interest in the investee results in influence that is less than significant and is in the form of a financial instrument, such as an equity interest, the guidance in IFRS 9, Financial Instruments, is applicable. This course focuses on investments under joint control and those for which significant influence is possessed.